economically speaking, the most important impact of the Russia-Ukrainian crisis is its impact on the Fed. Because at the end of the day, the Fed will drive the US economy and US stocks more than any repercussion of what's going on in Eastern Europe. That's the plain and simple truth. We've talked about this before. The Fed are the masters of the financial universe. They have significant more influence over the trajectory of the US economy and stocks than anything happening in Eastern Europe at the current moment. So the most important impact, economically speaking, of that crisis is what it does to the Fed. And what it does to the Fed is it forces a dovish reassessment of the market, of the economy, of their policy trajectory. Before all this unfolded, markets were thinking there was a 40% chance of a 50 basis point rate hike increase in the March meeting. Investors were pricing in. The base case was for the Fed to hike 6 or 7 times in 2022, with 8 hikes becoming a very real possibility. I think it was something like 20% probability of them hiking 8 times in 2022. This is all before the Russia-Ukraine crisis. Now look at those probabilities. Go to the CME group, go to their Fed Watch tool, look at those probabilities. 50 basis points is completely off the table according to the market. We were at 40% before the crisis. Now it's 0%. Literally, I just checked before this call, 0.0% chance of a 50 basis point hike in March. 99.8% chance of a 25 basis point move. So all of a sudden we've gone from they could very well hike 50 bips to they're definitely without a doubt hiking 25 bips. Look at full year 2022. As I said before, it was looking like 6, 7, 8 rate hikes. That's what the market was forecasting. That's what the market was pricing in. Now we're down to 4 or 5 rate hikes, with the outcome of 3 rate hikes gaining traction. That was a 0% probability a few weeks back. Now it's 10% and growing. So all of a sudden, it looks like we were going to get this super hawkish, super aggressive Fed tightening policy in 2022. But now we're going to get what is going to be a very dovish approach. I mean, I think when all is said and done, they're probably only going to hike 3 or 4 times in 2022. If that happens, yields have to come down because as we were talking about, I think on the last call, the spread between where interest rates are based on the Fed, the effective Fed funds rate, and the 2-year Treasury yield, which is supposed to track the effective Fed funds rate, is at all-time high levels. A week ago, it was like at 150 basis points, meaning the Fed was at 0 and the 2-year was at 1.5. But now the 2-year is collapsing and collapsing and collapsing because it looks like the Fed is not going to hike enough time to support a 1.5 2-year. So that means the 2-year's got to come down substantially. It probably comes down to 1% maybe. What's the impact on the 10-year? Well, you're probably going to still have a pretty narrow yield or pretty flat yield curve, a pretty narrow spread because there are a lot of economic and political uncertainties out there. So assume a 40, 50 basis point spread on those two, then you're talking a 10-year back down to 1.4, 1.5%. So you're going to see yields fall as well. In that scenario, where the Fed has a dovish reassessment of the market, where yields come down, where you only get 3 or 4 rate hikes in 2022, well, that's a scenario where US-based growth stocks excel because, one, they're US-based. Their earnings growth is not going to be impacted at all, maybe 2%, 3% by what's going on in Eastern Europe. And they're super rate sensitive. So they were destroyed in late 21 and early 22 as the market started pricing in 6, 7, 8 rate hikes. Now, if the market goes back to pricing in 3, 4, 5 rate hikes, that's a 50% reduction there in terms of rate hike expectations. That should lead to a massive boost in growth stocks. So that's why you're seeing US-based growth stocks weather the current market volatility with surprising resilience. And it's also why I expect them to continue to perform better than the rest of the market for the next few months and over the balance of 2022. I think that you're going to get a dovish Fed, you're going to get lower yields, you're going to get still strong earnings growth, and that's a cocktail for growth stock outperformance in the balance of the year.